Gold and Silver Massacre CME plus Shanghai Coordinated Attack exposed. Friday, April the 25th, gold collapsed 16% in a single session. Silver plummeted 38%. The worst single day in 45 years. Monday morning, thousands attempted to sell, orders rejected, circuit breakers activated, traders trapped inside their own positions, unable to exit at any price. But here is what nobody is telling you. Two exchanges, 7,000 miles apart, raised margin requirements at the exact same hour. CME Chicago, Shanghai Gold Exchange. Simultaneously, statistical probability of coincidence? Less than 0.03%. This was not a crash. This was an execution. Welcome to Metal and Macro. If you have been watching markets long enough to remember when gold was still under $300 an ounce, when silver traded in single digits, when central banks actually defended their currencies, then you understand that what happened last Friday was not normal market behavior. This is the kind of analysis built for those who have seen enough cycles to recognize when something fundamentally different is occurring. We would be honored if you would subscribe to this channel, not for entertainment, but because the intelligence shared here is designed for serious capital allocation decisions. And before we proceed into the full analysis, tell us in the comments, where are you watching this from? New York? London? Singapore? Mumbai? Because what happened in Chicago and Shanghai last week will reach your market next. Now, let us examine exactly what occurred and why it matters for every dollar you have positioned in this system. April 25th, 2025. The date will be remembered in financial history as the day 2 of the world's largest commodity exchanges executed what appears to be a coordinated strike against precious metals markets. Gold had been trading near $4,800 per ounce throughout the week. Silver had climbed to $117. Both metals were approaching psychological resistance levels that had held for months. Traders around the world were watching these levels closely. Some were positioned long, expecting breakouts. Others held short positions, betting on reversals. What happened next was not a reversal, it was a demolition. Within 6 hours of trading on Friday morning, gold collapsed 16%, silver fell 38%. These were not gradual declines, these were vertical drops on the charts, the kind of price action that erases accounts, the kind that triggers automatic liquidations across thousands of positions simultaneously. By the close of trading Friday, gold had fallen to $4,100. Silver had crashed to $75. The metals had given back weeks of gains in a single session. It was the worst single-day performance for precious metals in 45 years. Not since 1980, during the Hunt brothers' silver manipulation case, had the world witnessed such violent price destruction in these markets. Traders who survived Friday believed the worst was over. They believed the selling had exhausted itself. They believed Monday would bring stabilization, perhaps even a recovery bounce. They were wrong. Monday morning, April 28th, the massacre continued. Gold broke through $4,000, then $3,900, then $3,800. Each support level that analysts had identified as strong buying zones simply vanished under the wave of selling pressure. Silver crashed through $72. Every few minutes, prices updated lower. $4,700, $4,650, $4,600, $4,550. But something else happened Monday morning that revealed the true nature of this event. Thousands of retail traders attempted to liquidate their positions in silver exchange-traded funds. They wanted out. They wanted to cut their losses before the bleeding continued. Their orders were rejected, not delayed, not partially filled. Rejected entirely. The exchanges had implemented circuit breakers. The price had moved so far, so fast, that the system would no longer accept sell orders at current market prices. The traders were trapped. They could see their accounts hemorrhaging value in real time. They could see the prices falling, but they could not exit. The system had locked them inside their own positions. This was not a technical glitch. This was by design. While retail traders were locked out of liquidating, institutional players continued trading. Large block orders continued executing. The circuit breakers applied selectively, protecting some participants while exposing others to unlimited downside risk. Then, the pattern became visible. Researchers examining exchange data noticed something unusual. The Chicago Mercantile Exchange, the primary venue for gold and silver futures trading in the Western Hemisphere, had raised margin requirements late Thursday evening. Margin requirements are the cash deposits traders must maintain to hold leveraged positions. When exchanges raise these requirements, traders must deposit additional cash immediately or face automatic liquidation. The margin hike was significant. For silver futures, requirements increased by 40% overnight. For gold, 35%. Traders who went to sleep Thursday night with adequate margin woke up Friday morning facing margin calls. They had hours to deposit additional funds, or their positions would be sold automatically at whatever price the market offered. And the market was offering terrible prices. But here's what made this event extraordinary. The Shanghai Gold Exchange implemented nearly identical margin requirement increases at almost the exact same time. Shanghai is 7,000 miles from Chicago. The exchanges operate under different regulatory frameworks. They serve different client bases. They have different clearing members and different institutional relationships. Yet both exchanges raised margin requirements on gold and silver futures within the same 12-hour window. Both increases were in the 35 to 40% range. Both were implemented without prior public warning. Both took effect at the opening of their respective trading sessions on Friday morning. The statistical probability of two independent exchanges implementing such similar policy changes simultaneously by coincidence is less than 0.03%. This was coordination. And coordination at this level does not happen by accident. Someone orchestrated this strike. Someone positioned for it. Someone profited from it. The question is who and why now? Most people believe markets are fair. They believe prices reflect supply and demand. They believe exchanges exist to facilitate transparent trading between willing buyers and willing sellers. They believe regulation protects participants from manipulation. What happened in gold and silver markets over 72 hours in late April demonstrates how dangerously naive these beliefs are. The weapon used in this attack is called margin leverage. To understand how it destroys capital, one must first understand how it creates the illusion of wealth. Imagine a trader with $10,000 in capital. In a normal investment account, that $10,000 might purchase shares of stock worth exactly $10,000. Simple, direct. The trader owns what they paid for. Futures markets operate differently. With $10,000 in margin, that same trader can control a position worth $100,000 in silver. The exchange requires only 10% down. The trader puts up $10,000. The clearinghouse effectively loans the other $90,000 through leverage. If silver rises 10%, the position gains $10,000. The trader just doubled their money. This is the seductive mathematics of leverage, but the mathematics work identically in reverse. If silver falls 10%, the position loses $10,000. The trader's entire capital is gone. Not half gone. Not mostly gone. Completely wiped out. From $10,000 to zero in a single 10% move. This is the brutal reality of leverage that advertisements for futures trading rarely mention. Now add the margin hike mechanism. Thursday night, April 24th, thousands of traders held leveraged silver positions. They had $10,000 in their accounts, controlling $100,000 positions. Their accounts showed adequate margin. They were in compliance with all exchange requirements. They went to sleep comfortable. At 11:47 p.m. Eastern Time, the CME Group issued a margin requirement update. Effective at the open of trading Friday morning, silver futures would require $14,000 in margin to control that same $100,000 position. Not $10,000 anymore. $14,000. The traders woke up Friday morning $4,000 short. Each position that was perfectly legal Thursday night was now in violation of exchange rules Friday morning. They had until 9:30 a.m. to deposit the additional $4,000 or face automatic liquidation. But there was a problem. Most traders do not keep excess cash sitting idle in their brokerage accounts. They keep their capital fully deployed to maximize returns. When the margin call came, they needed to transfer funds from bank accounts. Wire transfers that typically take hours to process. By the time the funds arrived, the market had already opened. And the moment the market opened, the liquidations began. Here is where the cascade effect starts. When one trader gets liquidated, their position gets sold into the market at whatever bid exists at that moment. That sale pushes the price down slightly. When hundreds of traders get liquidated simultaneously, hundreds of positions hit the market at once. The price does not drop slightly, it gaps down violently. That gap down triggers stop-loss orders from traders who were not facing margin calls. Their predetermined exit orders activate automatically. More selling enters the market. The price falls further. That deeper fall triggers margin calls for traders who had been safely above the requirement just minutes earlier. Their positions now show inadequate margin due to the price decline. They get liquidated automatically. More selling pressure. Deeper price fall. This is the cascade. Each wave of forced selling creates conditions for the next wave. The process feeds on itself. It accelerates rather than stabilizes. Within the first hour of trading Friday, over 40,000 silver contracts were liquidated. That represents 200 million ounces of silver paper exposure, all of it sold into a falling market. All of it at progressively worse prices. The traders being liquidated had no control over the exit price. The system sold them out automatically using market orders that filled at whatever price existed in that moment. Some traders saw their positions liquidated at prices 5% below where silver traded just minutes earlier. Their losses exceeded what a normal market decline would have caused simply because the liquidation mechanism itself created additional downward pressure. But the true genius of margin warfare is not just the forced selling it creates, it is the timing advantage it provides to those who know it is coming. If an institution knew Thursday night that margin requirements would increase Friday morning, if they knew that increase would trigger massive forced selling, if they knew the approximate magnitude and timing of that selling pressure, they could position accordingly. They could establish short positions Thursday afternoon. They could buy put options on gold and silver ETFs. They could pre-position cash to purchase physical metal at crashed prices. They could profit from every dollar lost by those caught in the liquidation cascade. The margin hike becomes more than a risk management tool. It becomes an instrument of wealth transfer. Capital flows from those surprised by the change to those who anticipated it. From retail traders to institutional players, from the unprepared to the informed. And when the same mechanism activates simultaneously on two exchanges 7,000 miles apart, the coordination becomes undeniable. Someone planned this. Someone executed this. Someone is now counting profits measured in billions while thousands of smaller traders count their losses. The question is no longer whether this was coordinated. The question is which institutions had the power to coordinate it and what they plan to do next. Every crime scene leaves evidence. The gold and silver massacre of April 2025 left fingerprints across multiple databases, clearinghouse records, and regulatory filings. For those who know where to look, the identity of the orchestrators becomes visible not through speculation, but through documented institutional behavior in the days preceding the collapse. Start with the Chicago Mercantile Exchange itself. The CME Group is not simply a neutral platform where buyers and sellers meet. It is a for-profit corporation with clearing members who hold extraordinary influence over exchange policy. These clearing members are the largest banks and trading firms in the world: J.P. Morgan Chase, Goldman Sachs, HSBC, Citigroup, Morgan Stanley. They sit on risk committees. They advise on margin policy. They have advanced knowledge of operational changes that retail traders learn about only after implementation. 3 weeks before the April massacre, something unusual appeared in the CME's weekly Commitment of Traders report. This report, published every Friday, shows the positions held by different categories of market participants. Commercial traders, typically producers and industrial users, suddenly increased their short positions in silver futures by 18% in a single week, not gradually over months, in 1 week. Commercial shorts in gold increased by 12% during that same period. These are not small position adjustments. These represent hundreds of millions of dollars in new bearish bets placed by entities classified as commercial traders. The timing matters. This positioning happened before any public announcement of margin changes, before any visible market deterioration, before any rational technical reason to establish such aggressive short exposure. Someone knew something was coming. Now shift attention 7,000 miles east to Shanghai. The Shanghai Gold Exchange operates under the direct oversight of the People's Bank of China. It is not an independent private entity like the CME. It functions as an instrument of Chinese monetary policy. When the Shanghai Gold Exchange makes policy changes, those changes reflect decisions made at the highest levels of China's financial system. In the 2 months preceding April, the People's Bank of China accumulated gold reserves at the fastest pace in 5 years. Official reserve data showed additions of 62 tons in February and 71 tons in March. These are not routine purchases. These represent aggressive accumulation at elevated prices by an entity that typically buys during periods of weakness, not strength. Why would China's central bank pay premium prices for gold in February and March, then coordinate a margin policy change in April that crashed those same gold prices? The answer becomes clear when examining what happened after the crash. Within 48 hours of the lowest prices Monday morning, Chinese state-owned banks purchased an estimated 140 tons of physical gold on international markets, not futures contracts, physical metal, at prices 15% below where the metal traded just 72 hours earlier. The same central bank that bought at $4,800 in March was now buying at $4,000 in April. They sold high through futures positioning. They bought low with physical accumulation. The margin hike was not a risk management adjustment. It was a shopping mechanism. But China did not act alone. Regulatory filings in the United States reveal that 3 major commercial banks increased their short positions in precious metals derivatives during the first 3 weeks of April. These increases appeared in footnotes of quarterly risk disclosures that most analysts never read carefully. The combined notional value of these new short positions exceeded $8 billion. $8 billion in new bearish exposure established weeks before the crash. These banks are also clearing members of the CME. They participate in the risk committees that recommend margin policy changes. They had the means, the motive, and the access to coordinate the timing of the attack. Then there is the options market evidence. Unusual options activity often precedes major market moves. Professional traders who possess advanced information frequently express that information through options rather than futures, because options offer asymmetric payoff profiles with limited downside risk. In the 2 weeks before April 25th, trading volume in out-of-the-money put options on silver ETFs increased by 470% above normal levels. These were not small retail trades. These were large block orders, the kind that typically originate from institutional accounts. Someone was betting enormous sums that silver would crash far below its then current price of $117. Those options expired worthless if silver remained stable. They paid out massive profits when silver fell to $72. The mathematical probability of such concentrated bearish betting appearing by coincidence just days before the largest crash in 45 years approaches zero. This was not lucky timing. This was informed positioning. Now consider the geopolitical dimension. For 3 years, China and Russia have been working to establish alternative settlement systems for international trade that bypass the US dollar. Gold plays a central role in these systems. A stable, rising gold price strengthens the credibility of gold-backed trade settlement. It makes dollar alternatives more attractive to nations seeking to reduce dollar dependency. But a volatile, crashing gold price creates doubt. It makes gold appear unstable as a monetary anchor. It reinforces dollar dominance by demonstrating that alternative systems remain vulnerable to manipulation. The April massacre served multiple strategic objectives simultaneously. It generated enormous trading profits for institutions positioned correctly. It allowed central banks to accumulate physical metal at discounted prices. It damaged confidence in gold as a monetary alternative to fiat currencies. It demonstrated the power of coordinated exchange policy to control asset prices regardless of underlying supply and demand fundamentals. The question serious observers must now ask is not whether this was coordinated manipulation. The evidence makes coordination undeniable. The question is whether this represents a one-time operation or the beginning of a broader campaign to suppress precious metals prices while institutional players accumulate physical inventory at artificially low prices. History suggests the latter. The London gold pool of the 1960s, the Hunt brothers' silver manipulation of 1980, the nickel market crisis of 2022. Each episode followed similar patterns: coordinated institutional action, margin manipulation, forced liquidation of leveraged positions, wealth transfer from retail to institutional players. The names change, the exchanges evolve, the specific mechanisms adapt, but the fundamental playbook remains identical, and those who control the exchanges control the game. The bodies are still being counted. In the 72 hours following April 25th, 11 commodity brokerages filed for emergency liquidity support. 4 smaller firms ceased operations entirely. Their client accounts, frozen mid-crisis, remain locked in legal proceedings that will likely extend for months. The traders who held positions through these brokerages cannot access their remaining capital. They cannot transfer to other firms. They can only wait while lawyers argue over who bears the losses. The total capital destruction extends beyond simple price declines. When silver fell from $117 to $72, the mathematical loss appears to be 38%. But for leveraged traders, the real loss was total account wipeout. $10,000 accounts went to zero. $50,000 accounts evaporated completely. Retirement portfolios built over decades disappeared in 6 hours of trading. The leverage that promised to multiply gains instead multiplied destruction. Institutional players, by contrast, emerged not merely intact, but enriched. The same commercial banks that established massive short positions in early April closed those positions during the Monday morning crash. They sold silver at $115 through futures contracts established weeks earlier. They bought back those contracts at $75 on Monday. The $40 spread, multiplied across hundreds of thousands of contracts, generated profits measured in billions. Chinese state banks, having accumulated physical gold at crashed prices, now hold metal purchased 15% below recent highs. As prices inevitably recover, those holdings will show substantial gains. But more importantly, China now possesses additional physical reserves acquired at minimal cost to its treasury. This is how wealth transfers during coordinated market operations. It flows from the surprised to the prepared, from the leveraged to the cash positioned, from retail accounts to institutional balance sheets. The game is not rigged randomly. It is rigged systematically in favor of those who control the infrastructure. But the massacre reveals something more dangerous than simple wealth transfer. It exposes the fragility of paper metal markets relative to physical metal supply. During the height of Monday's selling, the price of paper silver on futures exchanges crashed to $72 per ounce. Simultaneously, dealers selling physical silver coins and bars were quoting prices above $90 per ounce. The spread between paper and physical reached $18. In normal markets, arbitrage forces close such spreads within minutes. In this market, the spread persisted for hours. Why? Because the paper market has become disconnected from physical supply realities. The futures exchanges trade contracts representing billions of ounces of silver that do not exist in available physical form. When forced liquidation drives paper prices down, it does not create corresponding availability of physical metal. The miners cannot suddenly produce more silver. The The refiners cannot instantly increase output. The physical market continues operating based on actual supply and demand, while the paper market spirals based on margin calls and forced selling. This disconnect creates opportunity for those who understand it. Informed buyers recognize that $72 silver on futures exchanges represented a pricing dislocation, not a fundamental revaluation. They purchased physical metal at $90, knowing that paper prices would eventually reconcile upward toward physical reality. They accepted the $18 premium as the cost of acquiring real assets during artificial price suppression. The business community must internalize this lesson. Holding gold and silver through exchange-traded funds or futures contracts provides price exposure, but it also provides counterparty risk, liquidation risk, and manipulation risk. The entities that control exchanges can change margin requirements without warning. They can implement circuit breakers that prevent selling. They can suspend trading entirely if they deem it necessary for market stability. Physical possession eliminates these risks. A gold coin held in secure storage cannot be margined away. A silver bar in a vault cannot be liquidated by a broker. Physical metal provides the ultimate form of financial sovereignty because it exists outside the digital systems that enable coordinated manipulation. But physical ownership requires infrastructure that most businesses have not developed. Secure storage facilities, insurance arrangements, verification protocols to ensure authenticity, liquidity mechanisms for eventual sale. These requirements create friction that paper markets eliminate through electronic convenience. The April massacre demonstrates that this convenience comes with catastrophic risk during coordinated institutional attacks. Forward-thinking businesses are now reassessing their precious metals allocation strategies. Some are shifting from futures contracts to allocated physical storage where specific bars remain segregated in the client as name. Others are establishing direct relationships with refineries to purchase newly minted product at closer to spot prices. Some are exploring blockchain-based ownership systems that provide physical backing with electronic transferability. The common thread across these strategies is the recognition that exchange-based paper markets no longer function as reliable price discovery mechanisms. They function as control mechanisms operated by institutions with interests that often conflict directly with retail and commercial participants. Regulatory response to the April massacre has been predictably inadequate. The Commodity Futures Trading Commission issued a statement saying it is monitoring the situation closely and coordinating with international regulators. This is the same language used after every market disruption for the past 4 decades. Monitoring never prevents the next attack. Coordination never produces accountability. The regulatory bodies that supposedly oversee these markets are captured by the institutions they regulate. Real protection cannot come from regulators. It must come from individual and institutional decisions to reduce exposure to manipulable paper systems and increase allocation to physical assets held outside the banking system. This requires capital. It requires planning. It requires accepting lower leverage and less liquidity in exchange for greater security and reduced counterparty risk. But the April massacre provides a preview of what coordinated institutional power can accomplish when directed toward market control. If exchanges can coordinate to crash gold and silver, they can coordinate to crash other markets. If margin hikes can force liquidation in precious metals, they can force liquidation in equity index futures, bond markets, or currency pairs. If circuit breakers can trap traders in silver positions, they can trap traders in any leveraged instrument. The specific market matters less than the recognition that the infrastructure itself functions as a weapon. Exchanges are not neutral platforms. Clearinghouses are not impartial referees. Regulatory bodies are not effective protectors. The system is designed to enable the very manipulation it claims to prevent. And those who control the system will use that control whenever their interests require it. The gold and silver massacre of April 2025 will be remembered not as an anomaly, but as a template. A template for how institutional coordination can generate enormous profits while destroying retail capital. A template for how margin manipulation can force liquidation at the worst possible prices. A template for how exchanges can selectively protect some participants while exposing others to unlimited downside risk. The question for business decision makers is not whether this will happen again. It will happen again. It is happening in other markets right now. It will accelerate as digital systems provide increasingly sophisticated tools for coordinated control. The question is whether they will recognize the pattern before the next attack, or after their capital has already been transferred to those who orchestrated it. The fingerprints are visible, the mechanism is documented, the next target is being selected, and the institutions that executed this operation are already positioning for whatever comes next.